The primary force behind today's dramatic market rebound lies in a string of impressive earnings reports from U.S. tech giants. Companies like Nvidia, AMD, and Microsoft posted better than expected revenue, primarily driven by artificial intelligence infrastructure sales, cloud services, and enterprise demand. Nvidia, for instance, saw a surge in AI chip orders that beat Wall Street estimates by nearly 20%, sending its stock price soaring. An ecosystem lift fell across semiconductors, software, and even consumer electronics. This tech-led resurgence helped shift sentiment from cautious to optimistic, making traders believe that despite broader macro concerns, innovation continues to fuel corporate growth. This financial uptick cascaded across the tech-heavy Nasdaq index, boosting investor confidence in other sectors like fintech and enterprise software, creating a self-reinforcing loop of buying momentum. The second part of that trajectory came from follow-up guidance. Many companies raised forward earnings projections and reiterated strong margins, particularly those tied to AI, cloud, and data centers. Analysts upgraded their rating and pricing forecasts, reinforcing the narrative. Despite inflation concerns and geopolitical friction, high-growth innovation remains a core driver of market strength. This caused institutional investors, mutual funds, hedge funds, and pension funds to rebalance portfolios, shifting capital toward tech exposure and away from safe haven assets like bonds. Consequently, volume spiked, bid-ask spreads tightened, and momentum traders piled back into long positions in names like Nvidia, NVDA, Advanced Micro Devices, AMD, Microsoft, MSFT, and even emerging stocks like OpenAI partner Arista Networks. The result? Nearly a 1.52% surge in major indices by midday trading, turning pessimism into a rally. The second key trigger fueling the rebound is shifting market expectations around the Federal Reserve. This week's weaker-than-expected labor report, in part due to softer job creation and stagnant hourly wage growth, has led economists and traders to revise their outlook toward a potential September interest rate cut. Bond markets, including the 10-year Treasury yield, reacted sharply. Yields dropped by 15 basis points overnight, signaling a risk-on shift. With borrowing costs expected to stay lower for longer, investors regain confidence that corporate profits won't be squeezed by aggressive rate policy. The dovish tone gave financials, consumer discretionary, and growth stocks a tailwind, enabling equity buyers to re-enter the market with calm conviction. The third important factor, and perhaps the most politically nuanced, relates to ongoing policy uncertainty under the Trump-influenced political climate. This morning, the president announced the firing of the Bureau of Labor Statistics, BLS, chief, citing alleged bias in unemployment data. While markets initially tensed over fears of politicizing economic data, investors quickly dismissed this as procedural turbulence. More importantly, tariff threats retained prominence in conversation. Trump again hinted at extending tariffs on India and the EU, hinting at prolonged trade friction. Yet traders seem to shrug this off, focusing instead on tech strength and Fed-led optimism. In essence, the market signaled a clear message. Policy turbulence can shake sentiment, but it won't derail a rally in the face of strong earnings and hopes for lower rates. Together, these three triggers, tech-led earnings triumphs, bond market easing expectations, and Trump-era political volatility cooling off, created a perfect storm for today's market bounce. Traders who missed yesterday's panic found a window to reposition. Institutional rebalancing brought volume back, and retail investors, triggered by meme momentum, flooded into growth names. Will this rally sustain? That depends on upcoming inflation data, follow-through earnings reports, and whether political tension remains in check.